Perfect. So that's a little bit about me and my bio, just so that you get a background about me. Is that I spent, the first half of my career in startups and in enterprises, selling and also buying infrastructure technology. So this would be data center technology, cybersecurity, SCADA systems, IoT systems. And about a decade ago, I did some investment banking, and then I've been with Vantage Capital for about 6 or 7 years, and now I've been with TELUS as a director, looking largely at the big data, IoT, security, investments. So happy again to be with you here. I have an MBA, CFA, engineer, so pretty wide range of experience, which is typical, I think, of venture capitalists. All of us sort of have done a lot of different things, which then give us a broad perspective of when we're looking at companies, and then also helping them fundraise. So I'm going to start and talk a little bit about the startup funding life cycle, just sort of the different stages a company goes through, where I think the best sources of funding would be for companies that are your stage, which I think is sort of new ventures. And then I'm going to go and do a little bit of a deeper dive for 5 minutes, probably into each of those different profiles: friends and family, angels, institutions. And then I just got some stats so that you could sort of see, and it has some names in there about some statistics, so you could get an idea of what institutional rounds look like, and maybe some different names that you could actually go after when you're starting to think of institutional rounds. And then after that, as we said, some Q&A. So I'm going through the material. If you think of any questions, things like that, we'll have plenty of time to address them towards the end. Okay, so starting out when you're fundraising, you shouldn't always be doing it, but if there's one thing that you could take away from today, is don't run out of money. Don't run out of your investors' money. Don't run out of your own money. When you're running a startup, having cash and having the ability to execute is really, really important. So fundraising as a CEO is probably one of the top 3 things. One of them is having a good eye for product. The other one is recruiting your team. And the other one is selling your stock and fundraising. So it should be something that you should always be aware of, always know when your cash zero date is, and really be aware of, okay, where am I going to be able to fund things? How much runway do I have? And, I tell this to sort of every single presentation I have, because I get asked this question a lot, like, what is sort of like the number one thing I should think of if I'm doing a startup? And it is, don't run out of money, because, always want to have optionalities as you move through your optionality, and also have time to sort of figure things out as you're building your venture. Okay, so some ground rules for fundraising, and I put this together the last couple of days, is my general mantra is sort of friend or foe, take the dough. It should be under the right amount, reasonable valuation under reasonable terms. But if someone is willing to give you money for your startup or for your new venture, and it's a good amount of money and its valuation and the terms are reasonable, you should probably take it. I think that you're trying to secure dollars to build your business. So I think it's a really good maxim. The other thing that I sort of say around fundraising, when you're looking at all these different types of investors, is you really need to be careful around how you price your shares. So it comes, and I see it a lot, and I'm not just saying this as an investor because I'm looking at a good deal, is that I see companies often that I think are just priced too high, and it really puts them in a crunch, because they then get really starved for cash, because they're then not able to attract funding, or they're not able to attract funding at under reasonable terms. They'll start to get tough liquidation preferences. They might start to have to get big dividends or coupons attached to them. So I think that as you're raising it, you shouldn't always be optimizing for the highest valuation, but sort of be thinking about, okay, I'm going to sell this much of my stock right now. This is what the post money is going to be. I'm going to build value, and then I'm incrementally going to move up. You're in a marathon here and not a sprint. So there should be upside for every single investor that comes in. So don't don't price your shares too high, especially early out of the gate. You know, I've seen, you know, common share structures that are in the $50 to $60 million ranges, and it just makes it impossible for VCs to even wrap their heads around, okay, what are we going to do? What are we going to do with that? How did the valuation get so high? And it also puts VCs in a tough spot, because, you know, we don't want to be coming in there and saying, okay, this is a down round, you know, we want to squish down other investors. So I think it is something that everyone should pay attention to. Also, different investors will have different expectations. So when you're early on in your fundraising cycle, you know, if you're raising $15,000 and you're able to sell your company for 2 or 3x a few years down the road, and your uncle makes $50,000, it's a really good outcome for an angel investor or a friends and family investor. But if you then go in and you raise a VC round and you're raising $5 million, and the VC then is able to sell it for you know, a 50% uplift, $7.5 million, it's not a great outcome for a VC, because the VCs will have very large amounts of money that we need to move. You know, a small fund will be $30 million, a large fund will be $1 billion. So if a VC is writing a $5 million check and they get a $7.5 million outcome, it's not a great outcome. So different investors will certainly have really different return characteristics. And I think it's also something to pay attention to when you're going through the cycle of investment. I think that you've got to be a great steward of capital. And I'm saying this sort of as you're going into meetings, is people need to trust you. They need to trust that you're going to spend money to create value, that you're going to throw nickels around like manhole covers, that you're going to be able to really, really build value for your company. And I think that as a CEO, you know, you have a fiduciary responsibility to be that great steward of capital. It is other people's money. And then I said, the final thing that I'd say is that raising money itself is not a badge of honor. You know, talking to investors is honestly, and I say this quite a bit, it's a massive waste of time, because if you're able to drive revenue by focusing on your products and your customers, that's way more valuable than actually raising money. So when you are raising money, you know, I think that you'll get a good sense from the market from talking to a handful of people, if it's a viable business, if it's a good time to raise, you know, if they're credible. If you're knocking on door after door after door after door and you're getting no, there's something wrong with the pitch. And, you know, I think that that's something to sort of pay attention to. So, you know, I think revenue cures all evils. Products and customer focused is really what we want to see as investors. And, you know, the other thing is raising a lot of money, again, is not a badge of honor. The more money you raise, it just means the more money that you're going to be paying out, and also the bigger preference stack that you're going to be behind. So it's really about raising that right amount of money at the right valuation, and then being a good steward of capital. And then, as I said in the beginning, rule number one is then don't run out of it, because it'll put you in trouble. It'll also put all of your investors in trouble too. So I think this is a pretty decent graph for different sources of financing. And also it sort of says around timeline, around when you should be looking at them. So when you're starting out, you know, you could look for family and friends, you could look for angels and seed, grants, and then for VCs, sub-venture debt, later rounds, and then you get into the IPO, M&A, JVs, mezzanines, and sales. Above the line is equity, and below the line is debt. So, you know, I think I've got another thing here, is that this would be, you know, sort of how I would prioritize going after funding at an early stage. Would be from friends and family, angels, grants, VCs rounds, maybe some shred financing if you need it, you know, maybe some crowdfunding if you need it. But I would certainly stay away from personal credit. I'd stay away from debt. I think that in the early stage, your financing should be equity financed, and it really should be around friends and family, seed rounds, looking at grants, and then looking at VC rounds. At an early stage, I would stay away from investment banking. I would stay away from junior venture listings. I think that these all have very large costs to them. It can be an incredible time waste. You know, you really should be looking for very easy ways to raise capital, and that would be around this friends and family, seed, grants, and then going to the VCs. So just sort of talking about different investor profiles, is friends and family when you're starting out is really the best supply of capital. And if you have some money that you can then use to then bootstrap your own company, I think is the best. You know, these days it's never been better to do a startup, especially with cloud computing, AWS, Google Cloud, Microsoft Azure. They all have credits for doing startups. So if you're doing a tech startup, it's very easy then to play with their platforms. It's very easy to develop new and innovative technologies. So I think with a very small amount of money, and this is why we're seeing a lot of new startups coming to market very quickly, is that you know, the technology stack in the landscape right now is just really ripe for investment. So, you know, I think with a good friends and family round where you're able to raise, you know, 25,000 to 150,000, will usually be able to get you at least to some type of minimum viable product, maybe even like one customer. So, you know, I think that sort of first family, really, that first round should be sort of within that circle of people that you trust. And then also trust you. You know, I think this comes down to raising capital from friends and family is more of an ethical question than a financial one. You know, can the person afford it? This is very risky capital. Do they know that if they're giving you $5,000 or $10,000 that they might never see their money again? This is a new venture, so you know, I think that's sort of the dynamic. And then in terms of what these rounds typically look like, is they'll be pretty diverse. So you'll see maybe about 6 to 8 people that help contribute that are on the common share cap table. The pre-money valuations will typically be sub $1 million. There'll be a common share structure so that there's no really special rights. They're investing right alongside the common shares, the founder shares. They won't typically get any board seats. The founders will typically will still maintain full control of the company. So there's no real impact in terms of governance or impact. It really is that seed money to really get you off the ground. So that's the friends and family round. The other area that, and I think that a lot of you would be very familiar with this because you're in the New Ventures BC competition, would be grants. So, you know, Canada has a wonderful grant program. You can't rely on it exclusively by any means. I think that you always have to take a look for equity financing on top of it. But Canada has been trying to create an ecosystem and has been creating an ecosystem for a long time at every single level, from municipal, provincial to federal. And at every single level, municipal, provincial to federal, you will find grant money, you'll find resources. These are the big ones. SHRED, so this is money for scientists and engineers. I'm sure you've covered this at probably during other sessions. IRAP, Canada Council, if you've got arts projects. I know people that have started, you know, pretty decent sized businesses that have arts flavors, that art flavor, they got money from the Canada Council. Grants.gov is a really great resource for US defense and other US special projects. Just because you're a Canadian company does not mean that you can't apply for US grants. Given I'm an infrastructure investor, a lot of my companies have gotten grants from the US defense and US military. So they're special work projects, they're non-dilutive, it's like revenue, but it really has helped to build your product. I found out recently the Alacrity Foundation is giving money for marketing. So I think it's $5,000 to $10,000 for companies in BC if you want to create some type of shop online, if you want to create any type of Google ads, Facebook ads, anything like that, you should go check out that program, the Alacrity Foundation. I think they just got re-upped from the BC government, and I don't think that a lot of people know about it. It was new to me, so I think that's a really great program there. And then obviously MVBC, hello world, that's a computer joke. And any others that you might want to find. So I think grants are really a great source of funding. A lot of our companies have a lot of grant money, so encourage you to really go through that trough of financing. And then you get into the angel round. So this is where things get a little bit more sophisticated. Angels are these high net worth individuals that are out in the community. They're somewhat hard to find, but if you're an expert in your field and you're starting a startup that is in the field, let's say you come from academia, let's say that you're doing some infrastructure investing, or you're doing some some infrastructure investing, you're doing some ag tech investing. There's certainly been some successful exits here. There's people that are known in the community for investing in this area, and they'll be sharp. They will know the industry. You'll probably have been connected with them. They're probably easy to due diligence. And then it's sort of more of a working relationship. Will they like your product? Will they want to add value? Is this someone that you think you're going to be working with them for 5+ years? We have angel networks within Vancouver, but also I think the angels that are around town, they do make themselves fairly well known in the community and also in the startup ecosystem for saying, hey, yeah, we did back this company. They're pretty visible. So I think they're a really good source of funding. Usually their check size will be anywhere between, I'd say, 25,000 to 150,000. That's generally their range of investing. So when you're asking, I think that would be sort of the check size. Usually you'll have 2 or 3 of them in a round, so you get a round size of maybe about 300,000 to $1 million. Your pre-money valuation then is creeping up a bit because you have something a little bit tangible there. It'll be anywhere between $1 million to $3 million. The security types here are all over the place. So they can be in common shares, they can be in preferred shares, they can be in safes or convertibles, which is a debt-like instrument. I think that you guys had a conversation with some lawyers about these different security classes. I think Faskins came and chatted with him because I looked at the agenda of some of the other things. So you might be familiar with them. I would look at, when you're looking at these types of instruments, I would just be, particularly with the safes and convertibles, which are supposed to be easy to transact, I would just be very pay attention to a couple of clauses in them. And the most important one is how they convert. So if someone gives you some money, how is it going to be converting into the next round would be something that I would always do the math on and think about. So, okay, if someone's giving me $300,000, really take a look at the share structure, understand the lawyer's math about what happens when this actually then converts into preferred shares. I think will be interesting for you. That way you can also plan options and you can sort of see how this all works. The transaction costs are relatively low. Especially ones that aren't priced. Priced rounds are a lot more expensive to do than safes or convertibles. Depending on the angel, especially if it's coming from an angel group or an angel network, they will want board seat typically. That's pretty common with angel networks, is that there'll be one angel that will take a board seat and they'll have a group of angels. And then the investor relations here, I've got sort of, it will be anywhere low to high. It depends really on the needs of the angels, how closely you're working with them. This is also when you start to lose control a bit of your company because they expect an exit. But the pro is that it's more money, really good advice, really good introductions, and really good support. And also the angels are really supportive throughout the whole life cycle of the company. I know some of my portfolio companies, the angels end up being trusted advisors, even when, their proportion isn't strong enough that they remain on the board, is that they've really become the trusted advisors to the CEOs and to the management team and some of the other board members going forward. I put a slide in here just in case some people didn't know how venture capital funds work. I work for TELUS Ventures, so it's a little different. We just invest off of the TELUS Ventures balance sheet. But it sort of gives you a little bit of the economics of how a venture fund works. And I think it's important because that then puts into context of what it looks like to then go raise money from a venture capital fund. So a venture capital fund isn't sitting on this big pool of cash. So when you see like a fund has 100 million or 500 million or $1 billion under assets, it's other people's money. And then what that is it's usually pension funds, governments, endowments, individuals, high net worth individuals. Some of them will invest directly into the fund themselves, and others will be funds of funds. And how that works is they'll do it on a subscription basis. So a venture capital fund will operate on a subscription basis where if someone says, okay, I'm going to invest $10 million on a $100 million fund, they'll write a subscription agreement. And then when the venture capital fund starts to make investments, they start to call the capital. So it is a bit of a process. It's not like a bank or even TELUS, whereas there's a large capital pool that's sitting on the bank account. It is funds that is then called throughout the cycle of the fund and then gets distributed into the portfolio companies. And then also a small amount is then goes for management fees to then help keep the fund operating. So when you start to look at sort of institutional seed rounds, is seed investors, how they typically operate is seed investors will do a lot of, if it's a true seed fund, is seed investors will do a lot of small bets. So you'll see a seed fund, they might be doing 20, 30 investments off of the seed fund. They'll typically invest locally. They'll help recruit. There'll be a sounding board. They will be stretched, I think, a little bit thinner than I think the Series A or Series B investors, because they do have to sort of, from a portfolio approach, invest in a much larger, riskier portfolio, but they will tend to know your industry. They'll be local, and they'll write check sizes somewhere in the range of about $500,000 to $1 million is about a typical seed investment. Usually seed investments will have a couple of seed investors in them, so your total round size is getting about to be 1.5 to 2 million, sometimes 3 million if you're looking at a sort of a deeper tech investment. And your pre-money valuation will anywhere between be about $5 to $10 million. These are by and large 90%. This is when you start to convert into a preferred shares and a preferred share structure. So this is when you actually then say, okay, I don't just have a common share, but I have a preferred share structure. That preferred share structure during an exit would be the first to pay out. It will have some protective provisions around it. Likely the seed investors will want some type of board seat. And the reporting here, I would say, starts to get to be higher. You know, you have to have good governance structure. They'll want to start to have quarterly financials because they'll report up to their investor base. And that's sort of when you start to give up a little bit more control, and then the exit on a specific timeline. Seed funds will probably exit anywhere between 7 to 12 years. So by the time that they put your first investment in, they'll be looking to exit that investment anywhere between 7 to 12 years from now. So that sort of gives you an idea of, okay, if I'm taking a seed investment, how long do I have? When do these people start to want to sort of realize their gains? So if you guys aren't familiar with the CVCA, I think it's a really great resource. This is the Canadian Venture Capital Association. There's one of these all over the world. There's the British Venture Capital Association. There's the Australia Venture Capital Association. There's the CVCA. TELUS is a member. NVCA is a much bigger organization down in the US. And I just wanted to give you guys some stats here to put it in perspective, to sort of say, okay, how many deals are being done? What's the velocity and what's the trend? So if you look at sort of, and this is just the Q1 stats, so sort of hot on the presses, and you can look at this every single quarter. CVCA will release these. We don't know, and they don't have a lot of visibility into angel rounds, and it is self-reported. So it might not be capturing everything, especially if there's US VCs or if there's large private transactions going, but I think it does give some pretty good representative trends about what's going on, especially when you sort of look at 2017, 2018, 2019, 2020. You know, the funding economies up and to the right. You know, we're seeing a lot more deals. We look at 2021 across Canada, 2.7 billion in deals. That's, you know, almost 50% in one quarter what happened in 2019 pre-COVID. So it's an excellent year for funding across Canada. There's a lot of dry powder. It looks like there's a lot of money out there, and it is going to deals. This is sort of the activity by deal size. So lots of big mega rounds, 16 mega rounds, but you're seeing that there's a good collection in Q1 of these sort of sub 20 million deals, 100,000 to 20 million deals. There's certainly about sort of 140 deals that happened in that range. So I think those are encouraging stats when you're going to fundraise. And I wanted to put this slide in here too. And you can get this all from the CVCA website. This is all they do, a report every single quarter that you can download. This is the activity from seed, early stage, and later stage. So you can see the number of deals that are going on. And this is just Q1 71. So again, you know, pretty active. So you could see the seed deal sort of peaked in 2018, trailed off a little bit. And then, you know, I think we're having a robust seed rebound. So it looks like, just based on the Q1 metrics. So, you know, once you sort of have that product and you have that minimum viable product and you have a couple of first customers, which are those, I didn't talk about that a little bit, but that's when you really should start to look at your seed financing. Once you have that MVP and a couple of good customers, I think that's when you should start looking for your seed round. It looks like it's a very, very healthy climate right now to be seed fundraising. So I think that's encouraging. Hey, and then look at this. The CVCA put a list of all the contributing firms. So these are all the active firms right now that are doing the deals in Canada. And if you wanted to take a look at the NVCA, the ones in the US, we have a lot of US funds that are investing in Canada also. They would also provide a list of who are the contributing funds. So I think this is a very good list of sort of doors to knock on about people who are active in the funding community right now from an institutional perspective. So again, tips and tricks for managing investors: don't run out of cash. I think also once you start to take your very first dollar, you have to start meeting your operating plan. So, don't set unrealistic expectations around what your revenues are going to be, what your expenses are going to be. Really, when I look at investment team, when I look at CEOs and I look at their team, it really is, are you able to manage to an operating plan? Do I trust your metrics? Do I trust that you're going to make the quarter? When is your cash zero date? The worst thing as an investor that you want to know is you go into a board meeting and you thought that there was, a year and a half of runway, and it only turns out that there's 6 months. It just puts everything in a really tight squeeze, particularly the entrepreneur. You don't want to be in a position of weakness. You want to be in a position of strength when you're fundraising. Monthly emails for your investors and interested parties, I think, is like the best thing to do. I think that in this type of funding climate, if you're getting a lot of people knocking on your doors and you want to invest and you're just sort of heads down, you're building your business, have a monthly blast where you talk about what you're doing, what you're working on, what are your asks of the community, and then also add interested and vetted parties to this email blast. I think it's a really good way for people to sort of keep front of mind. And then I'd also say manage investor opinions. As you sort of grow your investor base, no one's going to know your business better than you, and especially when you're out fundraising. And I sort of say like investors' opinions are like buses. They'll have a lot of them, but they won't be going where you're going all the time. So you have to really know which of those investors knows your business, is going in the right direction for you, has been there and done that, and listen to them. And the others, it's polite, it's interesting advice, and you have to be cordial. But really, I would not be sort of, and I see this at times with CEOs, is they'll talk to an investor and then they'll change direction. And I'll be like, why did you change direction? Well, this investor told me this. And I was like, well, that's not a reason to change your direction, right? Because an investor told you to. You've got to have conviction around where you're going and have consistency of purpose as a CEO. And then the final thing is, I'd be very careful about handing out board seats. I do it sparingly. So each of these people will want different types of governance mechanisms. Maybe they want to have the board seats. It's very difficult to actually remove people from your board once they're there, and it can create a lot of bad feelings. So as we go through these different investor profiles, typically you'll have maybe one person that represents a very wide angel group. You might have one seed investor, and then once you get into your series A, your series B, some of those might drop off, and then you have to create room for your series A, series B. It's not great, as an institutional VC, to sort of go in as their very first institutional round and have a board of 7 people and say, okay, well, I don't know why there's 7 people on the board and I'm coming in and now there's going to be 9. That's not manageable, and that's too many voices for an early stage company. So I think early on you want to keep your board very lean, very mean. Even some of the seed stage companies I've met with, our board meetings would be a couple times a year. They weren't super formal. So I think the form sort of has to fit the function that way. I said that I would sort of rip through these pretty quickly, and then I would open it up for questions if anyone wants to. And I'll sort of keep the slides up here, I think, for a little bit if people want me to go back and go back on any material. So that was the bit about the formal presentation.
Awesome. Thank you, Brian. That was a great overview. So yeah, you can put your question in the chat and I'm happy to ask it. Or if you want to ask it, just put your hand up. And you can unmute yourself once I call on you. So I'm going to ask a question from Robert in the chat, and then Adam, I'll go to you. So first, Robert is asking, what percentage of equity would be typical in the friends and family seed round?
I think anywhere between, 15 to 25%, around there.
Okay.
Yeah. I think for each of these rounds, you're looking at about giving anywhere between 15 to 25% of the company up in each successive round.
Okay. Okay, Adam, go ahead.
Great. Hey, hi, Brian. Thanks for the informative presentation. So I'm at Agents Republic, where we provide multilingual customer support, and we are also starting fundraising in July. And my question is that how do you see valuations have changed in the past 1 or 2 years?
Man, inflation's real. Like everything, valuations are going up. So it's yeah, I think that there's a lot of money in the system. It's going to high quality teams and high quality deals, and it is driving valuations up. And I think that those metrics, if you wanted to go with the CVCA and the MVCA, you could see those metrics, and some of those valuations are certainly posted where it's known. But I think that yeah, it's the valuations are certainly getting a lot higher.
Mm-hmm.
So
awesome. Great.
Right.
Thanks.
Thanks, Adam. Okay.
So also, I'm going to preface it. It's getting also, once you start to bring a product to market, it takes less money to create, but then there's so much competition in the market around sales and marketing is to then grow. You have to raise more money to sort of get the noise out of the market and take your company to market. So you have to raise more to sort of go to market. And that also increases the valuation, because you start to say, okay, well, if I'm going to build a full sales and marketing team, and I'm going to do a full growth team, and I'm going to do when I first started selling stuff in the 90s, I was the marketer, I was the SDR, I was the account executive, and sometimes I would even implement, right? And I was with a startup, and all these roles now for scale have been teased out. So you have very, very specialized roles that you need to recruit for, even at the seed and the Series A, to sort of start the flywheel, to start that sort of growth engine. So it takes a lot more money, not necessarily to create that MVP, but then to land those customers, make them more successful. And I think that in a degree is also driving up valuations. Is just there is more money needed, and then because of the percentage ownerships and sort of the expectations there, that it's that's also what drives up the valuation. So it's not just around inflation. I think it's also the cost of actually bringing a company to market.
Got you. Awesome. Thanks.
No problem.
Okay, Bruce is asking, any thoughts on services like Fundable or Front Funder that will help startups through the process of raising money?
I'm not super familiar with them, and that graph that I showed sort of really early on, because it was an old graph that I pulled from an MBA class. They didn't even have crowdfunding on it, so I sort of put it on the second slide. I'm not super familiar with them. I've never used them myself. I've had one portfolio company that has used crowdfunding, and I think that crowdfunding, because I'm an infrastructure investor, which is mostly B2B, I don't think that lends itself very well to crowdfunding, because usually investors want to know what they're investing in. So when you're looking at it through that lens, the best companies that I think the companies that do really, really well through crowdfunding platforms will be the ones where the consumers understand. So it's more consumer products. I have had one company that did do crowdfunding. It was a consumer product. It was able to buy some working capital. It was able to probably pay about 25 or 30% of its operating costs to sort of get that first product to market. So I do know it works. You get a pretty diversified shareholder base. You don't get the expertise, but I do know it's a thing. I don't have a lot of expertise in it, unfortunately.
Okay, well, to piggyback on that, there's yet another crowdfunding question. Maybe you can just wondering if it can be risky in terms of IP.
If there can be a risk of crowdfunding in terms of IP.
Mm-hmm.
I'm not a lawyer, but we sort of play them sometimes, and I don't see the fit. Does anyone want to sort of add the context around that? Maybe sort of tease it apart, and then I can understand it a little bit better.
Yeah, Jolanda, maybe you're welcome to either put up your hand or just type some more details, and we'll come back to that question. So in the meantime, Ali has their hand up. Go ahead, Ali.
Yeah, hey, Brian, thank you for the presentation. Quick question is, how do you know how much to raise for pre-seed? I know an idea is you should raise either like as much as possible or how much ever money you need. But in theory, you could need as much money as you can in order
No,
to
don't raise as much as possible. Don't raise as much as possible. Raise what you need. It's the right amount at the right valuation under the right terms. And the right amount should be, you shouldn't be perpetually fundraising. I think that you should raise enough money to be able to get you going for a year, year and a half, so that you sort of raise the money. You're able to say, okay, I have enough money. I'm able to build a product. I'm able to maybe recruit a team or two. I'm able to get everything legally structured and then try this out for a little bit. But as it goes down, so I wouldn't say that you should try to raise a ton of money. I think that you should be raising in those bands that I had previously. So, you know, $50,000 to $150,000 for friends and family. I think the angel round should be 500,000 to $1 million. Your seed round should be $1 million to $3 million. Like that's really should be those ranges, and each one of those ranges should be able to last you anywhere from a year to a year and a half.
Okay, thank you.
No problem.
All right, Samuel is asking, does it make sense to start a seed raise as the first round?
It does if you have a lot of credibility in the space. So when institutions will invest in a seed round will be if it's a spin out from a university and there's been a lot of intellectual property that has then come out of it. If the founders had success in the space before, so if there's been an exit in the space, or let's say they were part of an executive team, I think that you could credibly go to you could go and raise a seed round. That being said, a seed stage company needs to have some type of prototype, and usually will have to have some type of customer validation. Unless it's like some really, really hard tech, like quantum or material science or chemistry or something like that, your seed rounds will want to, your institutional investors will want to probably see a product demo and do some customer calls. But that, if it is coming out of a university, if it is coming out of a management team, then I think there are, and I've done those before, there certainly are exceptions to that rule. So.
Okay, great. So Mitra and Naresh both have kind of similar questions around valuation. You know, the first one being, before you start a fundraising round, how do you figure out the valuation for a startup? And then Naresh is asking, same thing, how to evaluate the value of a company that's pre-seed stage, but has completed a startup incubator program.
Yeah, well, again, I think that if you go to CVC or MVCA, you'll see the ranges of what seed valuations are. You know, they're typically in the range of, a seed round will be in the range of $3 to $5 million. Like that will be the typical valuation range, and you'll be raising again somewhere between 500,000 to $1.5 million. So I think that gives you a range to play with, and the valuations will be dependent on the experience of the management team, how far along the product is, and if there's revenue traction, and how addressable the market is. So if you've got some great tech that has really a high degree of differentiation, has some type of moat to it, has an executive team that has been in this area before, you can command that higher end. And if you're doing it for the first time, you're stumbling around, then it would be on the lower end. So I think the valuation ranges are somewhat set. And yeah, that's then how do you determine it? So when you're actually sort of going to investors and you're doing that seed round, they'll ask you, what are your valuation expectations? And, I would say that what I think the best answer there is to say, we're going to let the market determine it. We're talking to a number of different investors. We've got a bunch of people that are interested in it. We're raising $1 million. We'd love for you to be part of it. If it's a priced round, that's that. And if it's a convertible round, then you already have the paper. You would say, okay, well, this is a convertible round. It's 20% to the next financing with a valuation cap of $10 million. So, on the paper, that's the debt paper, the debt-like paper that will convert to equity. You can price it yourself. But the ones that's the preferred shares, and when you're starting to talk to institutions, the institutions will be the ones that set the round, not you. So it's better not to go with a valuation expectation when you're talking to an institutional investor. It's better just to go with the amount and saying, I'm raising 500,000, I'm raising $1 million. This is what the valuation of my last round is. You know, do you think we want to work together? But I wouldn't go into institutional investors commanding a valuation.
Okay, great. Okay, a couple scenarios here for you. So this one's from Charles. So I think Charles has a company that's in revenue, but I think they're trying to launch a new product. So the revenue is from something else in their company. So they have preliminary material and a couple of companies who are interested in using the product when it's done. What are your recommendations around funding?
So they have revenue. The company has revenue.
But it sounds like, and Charles, feel free to unmute yourself. But it sounds like revenue. Yeah, go ahead.
We can have a conversation around it for sure.
Yeah.
Can you hear me?
Yep, go ahead.
Yeah, we provide software services to our clients. So that's not related to the product we're trying to build. So, you know, that's enough to get by with the company, but not a great enough.
So you're a services company, if I'm getting this right, and you've got a product that you want to launch, right?
Yes, that's correct.
And you want to sort of say, okay, and do you have people using the product yet?
No, it's not done yet, but we already have clients expressing interest already.
Yeah. Well, and what's the barrier for getting those customers onto the product?
Really product completion.
And do you have enough revenue from your services that you can complete the product?
Yeah, we do, but not enough to, you know, we can get them on board, but not enough to do a full scale public launch.
Well, I would say that you should maybe, if you have a really trusted customer, and I don't know your product at all, but could you do some type of beta trial that's even paid, you know, for just a few months?
Yes, for sure.
Yeah, I think that would be the easiest thing. I think even if you have 2 or 3 customers that are just in a private exclusive beta that you know you trust and that you trust and they trust you, and you can explain the situation and be honest with you, it's going to deliver some value. And you're giving them some type of sweetheart deal on the pricing, you know, for the first couple of years, and to provide some feedback around product and features and to customize it for them. I think that creates a really good win-win situation, and you can go to investors and you can start to raise off of that. Now, the tricky part is that a lot of investors will shy away from services businesses. That's the honest truth. I'm not like that. Services businesses don't scare me that much. Just as long as the services can be used to sell the product, right? So I think that then comes to a question of saying, okay, if I have the services offering that I'm doing right now, and I have this product, and I have these people that are delivering the services, how do I then start to use those services to sell more of my product? Because you don't want to have a services arm over here that's then disconnected to your product. So I think that's where the VCs will start to poke around a little bit, and they'll say, oh, you're a services company, everything's bespoke, you know, it's not, you know, these are one-off engagements, and you have to be able to say, no, we're revamping, like our services is what's got us our first 3 clients. And once we get these 3 clients, our services are going to be used to help sell our product and onboard it. So the services then is just an attached to get more product revenue.
Great, thank you. So once we sort of get the MVP done and customers using it, that's when we should consider going out to the market to get funding.
Absolutely. I don't think that there's a point yet, because you know, it sounds like you're at that stage where you could start to credibly go to seed investors and ask for $1 million, right? And start to have those conversations. But I don't think it might be a little bit too early until you actually have a product with a few customers on it.
Thank you. That's great.
It sounds like you're in a good position. So
that's good to know. Thank you.
Yeah.
Okay, so another kind of scenario from Mark. So Mark's company has finished their MVP, but now, of course, there's no money left in the bank. So do you recommend trying to raise an angel round for going to market, or getting a shareholder loan, or what option do you recommend?
Angel round. I think that would be good for an angel round. That sucks that you've got your MVP product and you're not able to. Angel round, or if you have an MVP, if you could anyway start to knock on doors to drive some revenue towards that product. I don't know what the product does. I don't know if that's a possibility, but I would say angel round or an MVP. You could do some shareholder loans. I guess that you say like bootstrap it or self-finance it. Yeah, that's always a possibility. If you've got money in the bank to fund your startup, you should do it through some shareholder loans. I'm not sure that you'll ever get those repaid. They'll usually convert into some type of equity at the next round.
All right. So, okay, back to the question about IP protection and crowdfunding. So additional context. So it was around risk around divulging proprietary information that enables copycat products for a B2C play in the life sciences space.
Yeah, so you sort of want to do stealth, but then you want to do crowdfunding too. You know, like it really depends on the life sciences and the idea. I don't think that large companies, including TELUS, which are public, so we're pretty much an open book, are able to innovate and raise money on the public markets without telling everyone what we're up to. So I think that you have to balance, how are you going to then raise that money, tell people this is a market that you're going after, without telling people exactly how you're going to execute on it. It has to be some type of there has to be some type of defensibility to it. I think that's what it comes down to. So if it's a B2C in life sciences and it's not super defensible and you're worried about people ripping off your idea through a crowdfunding, well, what happens when you launch your product? Because there's a lot of people that are fast followers, you know, including some really big companies are fast followers. Like they're the best fast followers. You know, I'm not going to name names, but you know, a lot of the Fortune 50 companies are the best fast followers in the world and have been for the last 20 years. So I think that you have to come up with a defensible product where you're comfortable both fundraising and telling people what it's about and being an open book about that without divulging exactly what your secret sauce is and how you're going to execute and bring it to market.
All right, we've got about a few more minutes left. I've got one more question here. Last call for questions. Let's see here. This is another bit of a scenario. So maybe if we just have a general answer for this. York says they've got a technology system product plan for telecom operators. They've got interest and need an MVP to demo, but there's no letter of intent. How do I get funding? So again, early stage company.
Yeah, I have a technology and system product plan for telecom operators. I have interest and need I have interest and need. I guess it's who the interest is, but no letter of intent. How do I get funding? Yeah, I think it would be from angels, telecoms, and I work for a telecom. I'm going to say that telcos work well with early stage companies when it's not core to our network. You know, core network stuff, you know, is typically, you know, go to the large players that are very, very reliable. So, you know, TELUS does a lot of investments. We're the largest corporate venture capital group in Canada by any type of metric, but it's really around next generation revenue streams, you know, around intelligent and around different areas, around health, around ag, around data analytics, you know, big data. So, you know, it might be challenging around where you're going to be trying to sell to telcos. Maybe you could talk to some of the networking companies, people that come from networking companies. You know, we've got there are some seed stage funds that specialize in those areas that are more around networking gear. So you've got the Alacrity Foundation that's got a background in that. You've got some other companies that are in Toronto that background that, but I wouldn't look at the telcos to necessarily be the direct investors in that. I would look at more of the people that build the equipment and then fund those types of equipments. Hopefully that helps a bit. If you want to message me privately on LinkedIn, you can, since I work in the industry. I can maybe help you out a little bit.
Thank you. Okay, so Mahesh is asking, can you raise other than friends and family if you are pre-revenue? What kind of a round is typical at this stage? Angel pre-seed.
Yeah, you certainly can raise money if you're pre-revenue. Absolutely. But I think that the companies that get funded that are pre-revenue are ones that have some type of credibility from a product perspective, that come from a university, that have some type of IP spin out, that are founding teams that may have been around an area before, even one person that might have been a director or a manager in a startup, that have that credibility. I think it's very hard to raise money from institutions or angels pre-revenue unless you have credibility in the space. You need to have some type of credibility. You need to have been with a startup at some capacity, been there, done that, or have come from a university background that has some IP spin out. I very rarely see companies that are pre-revenue that get institutional funding that, unless they have those characteristics, that are just an idea from someone that doesn't have a big background, either academically or from a startup in the space.
Okay. Do you recommend joining, this is from Fernanda, do you recommend joining the type of hubs that promise getting you the proper angel investors for your projects?
The Angel Network of Vancouver, I think that there's funds that have come out from that. I think SFU has an accelerator pitch those angel investors. I think Karitsu's got a good background on it. Some of them do cost to pitch, so I'd be wary of that. But also, I think the Vancouver market's relatively small. That if you're in an area and if you've taken some university courses, or if you're in New Ventures BC, or if you've got some cohorts, or you're going through some different accelerators, they'll be able to line you up with the proper angels. This isn't the biggest community. It's not a big city.
Yeah.
So I don't think that there's like a ton of like pay to play angel networks here in the city.
All right. So, Will, feel free to clarify if I'm answering this wrong. So after a company does 1 million, it's now in the private banking stage. What's the next stage as a sole holder to grow?
I don't understand the question.
Okay.
Yeah, sorry.
Yeah. So, well, maybe if you can clarify that, go ahead. I'm not sure either. Okay. Michelle is asking, do you know any institution that may be more interested in investing in the health tech sector? We are developing a specialized device for dentistry that sanitizes aerosols. Okay.
Oh, that's interesting. Health tech isn't my specialty. To be honest, I'm an infrastructure investor, but I think there are institutions. So I would just do your research. There are certainly institutions that specialize in med tech devices. Oh, forget that one that's coming off the top of my head in Toronto. Specializes in med tech devices. Go through the CVCA list. I know that they're part of the CVCA. You'll find them. For sure there are, and there's ones in Seattle too. We didn't, maybe just a couple minutes here, because you guys are competing. You're completing the New Ventures BC program, and I think this was the all about investors was something that we talked about. But Angie, did the cohort talk about any of the different accelerators and the accelerator program sort of in our area in the Lower Mainland after New Ventures BC? Techstars.
Yeah, some. I mean, we certainly have had some as part of our speakers, and we promote their events, but not like a direct list was provided.
Yeah, I think that as you go from New Ventures BC and you start to get that first product, I think that the accelerators are just fantastic. Techstars does a really, really good program for deep tech investing and sort of infrastructure investing. That's one that I follow closely out of Seattle. They take a lot of cohorts, but that's not the only one. There's Grow Labs. There's others in Vancouver that do more B2C tech. So, I think that that's a great area that provides co-working spaces. They'll provide intros to investors. It's another accelerator program like this, but this is sort of the things that you do as you sort of grow your company. As you do the New Ventures BC, then you might do an accelerator. They'll connect you with the right angels. They'll connect you with the right people that are funding in that area. So a lot of people that I think are really interesting, and it's just too early for me to go to, is I try to make them, if I like the company, really warm introductions to those accelerators, and they've had really good success because right at the other end of the accelerator are the pitch days for the angels and for the really early stage investors. So it is something that I think that, you know, if you've got a really good pitch, if you've got a really good MVP, is really explore, I think, as a next step for funding, and we didn't talk about that investor profile, would be the accelerators. And there's a lot of money that goes towards them. And then there's also the really famed ones like Y Combinator and things like that, where I think anyone that comes out of them gets a couple $1 million, but they're really hard to get into.
Yes, no, I know a few companies last year had been through YC and many applying. Yeah, I would just add on to that and say, I mean, most accelerators in BC aren't necessarily investing, but they can certainly help you get the investment. But the one that probably is the most successful from just what I've heard anecdotally is probably the Creative Destruction Lab.
Oh yeah, Creative Destruction Lab is great. Yeah, they're doing their CDL sessions. The super sessions are happening right now. Forgot about that one. We're sponsored that when I went to the session yesterday. Yeah, they're fantastic, and they've just done another one in Seattle. So CDL is the biggest accelerator. Sort of forgot.
Yeah, no, they're great, and they have a very good track record in terms of graduates from their program and winners of our competition. So they definitely do a good job.
I've invested personally into 3 CDL graduates, if not more. So really fantastic program. I think Techstars have done 1 or 2. So Angie, thanks for that.
Awesome. Okay, I think that's pretty much. We're out of time, so let's wrap it up there. Brian, thank you for both your presentation, your time, and your openness to answering all those questions. It's been great.
No problem.
And, yeah, great. And of course, TELUS Ventures, longtime sponsor of New Ventures BC competition. For the first 5 years of our 21 history, we were actually called the TELUS New Ventures BC competition. So, you know, they've been a great supporter of New Ventures and tech startups in general. So for those who have attended most of the weeks, just a very nice big thank you from myself for attending and joining us over this time. We will be doing more topics. We will still be around. So if you have requests, please do let us know. We'll send out a survey where you can put in your requests. Otherwise, have a great day, and thanks again for joining us. And thanks again, Brian. Take care, everyone.
Bye. Good luck.
Thank you. Bye, everyone.